Good afternoon and welcome back to the latest edition of the InvestTalk market analysis for the week ending February 21st, 2025. And this week I'm titling the video Options Expiration and Policy Uncertainty Spark Volatility. And that's what you got this week. This is the weekly heat map for the S&P 500. And you can see outside of Apple, pretty much all the bigger names were down. Tesla down over 6%, Amazon 5.5%, Nvidia was even down about 1.5%, Broadcom nearly 7%. Meta down 6 after a strong kind of start to the year. Google down 3, and really the strength was in healthcare. You see the healthcare tech, utilities, and energy. Those got some strength, and the consumer staples in that area. Those are really the only strength in markets, and it was really had to do with Friday. Here's the one day on Friday. You can see Nvidia down big, Google, Amazon, but you can see that these were already down. Most of these were already down for the week as a whole. So it wasn't just that the one day on Friday. It was the week as a whole that was definitely in the red. So I'm going to highlight title of the video that is option X, because that's usually a time for inflection. I don't think it's a coincidence that we had the market sell off. So how it works is there's something called a gamma hedging by market dealers. Basically, when they sell options, and with the amount of retail investors that are buying options, these market makers are having to go in and buy the underlying stock in order to hedge themselves when they are selling these options. And so what happens is once a lot of those options expire, as they did on Friday, they can readjust their books and lower their hedging against those options, and because they're now expired. And now what do? They sell the underlying shares that they have. So there are other factors as well, but it's not a coincidence that we had the big red day on Friday OpX, and this is good evidence that this is a very important aspect to market structure in today's environment. And so, do you get follow through next week? I think that's very possible, right? Continuing unwind and adjustments, especially as a lot of these names have come down. It's reflexive. When things are going up, they're having to buy more and more to hedge themselves as markets are going up. But vice versa, if markets roll over, they actually exacerbate the volatility. They sell a lot of their underlying because they no longer need to be as hedged, because the options that they've sold are farther away from the money or out of the money, et cetera. So understand that. I know it's complex, but it's very, 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 very important in today's market. So that's a big factor. And then you have policy uncertainty, with Doge and all of these things that the government is doing, potentially laying off 300,000 federal workers. And there's just a lot of uncertainty around what this administration means for the broader economy, specific sectors, et cetera. And so, I think that's part of this sell-off. Now, I'll get to some other backdrops they're actually generally bullish in the short term. But first, let me dig into the economic numbers for the week. So you have the housing market index that did dip down to 42, the lowest level since September, and shows you the housing market is certainly unwell overall, and you can see that in the home builders, which I'll show you in a little bit. The New York Fed Business Leader Survey, that did tick down to the lowest level. Where are we at? Lowest level in, let's see, just since the end of 2023. So that's interesting. How you have housing starts down 10% in January, the lowest level since April of last year, March of last year. And this is the tariffs, potential tariffs on lumber, certainly are not going to make these home builders very anxious to start homes that are potentially going to cost more than they expected to build. And so I think a lot of them are holding off, and that does impact economic activity, job creation, et cetera. So, and here's a 30-year mortgage, still hanging around, not above 7 like it was back in January, but you're still hanging close to that level. So you're not getting some tailwinds from the mortgage market. I thought this was interesting. Natural gas, this is the 5-year chart, which you can see is in the winter, you do get a drawdown in natural gas because it's cold and people are using heating and such. But what you can see here is that, you had one big dip back in January of last year, But you have one that's almost as big and it's been more consistently negative. And so what you can see is, it's been a cold winter, and they're drawing down natural gas. And that's why natural gas prices are getting stronger. Existing home sales month over month, so had nothing to do with the new home sales. It's how are consumers viewing the housing market and how many are going through. And you can see is negative 5% existing home sales month over month. So not a good look on that front. And then consumer sentiment, that was did get it tick down the lowest level since the election, right? Because election, we were roughly here in November, 71.8. We got that Trump bump, but obviously with what's going on now, it's a little more murky and a lot of uncertainty, and so consumers are more uncertain, and not a shock to see that flow through to the housing market data. And this is actually feeding into the expectations for Fed rate cuts. Yet last week, you had a slightly better than 50% chance that there would be a pause between now and June, meaning the next 3 meetings, the Fed would not do anything on the rates front. Now you have about a 2/3 chance that there'll be at least one cut and maybe more between now and June. And so, the economic data is certainly weakening overall. You're seeing better economic data in Europe than expected, but worse economic data than expected here domestically. I wanted to highlight this too. There's a couple of charts that I want to get into. This is the bank credit. Okay, this is about how much bank credit is being extended. So this is percentage growth from a year ago. I've talked about this before, but what you can see here is that it's not a shock. Remember, the market inflected positively in the fall of 2023. This has been an uptrend. So when bank credit growth is headed higher, that is liquidity going into the system. Remember, what everyone says, the Fed and the Treasury, they're the ones that are creating money and doing all these things with QE or whatever people think about what they're doing. The simple fact is that bank credit growth is the true source of what we call broad money. Okay, there's base money and there's broad money. The Fed and the Treasury, they can create base money, but broad money is money that's lent out into the system, and banks have a lot of control over that, right? And so, and if you look back here, this is, everyone talks about the 70s and the inflation that was created in the 70s. And what you can see here from 75 all the way until 79, look at this bank credit growth. It peaked out at nearly 15%, right? About 14.5% year over year. So that's the liquidity that goes into the system. That's the inflation that is being pushed out into the system, the money that's being pushed out into the system, et cetera. And if you look over the last 10 years, this was COVID, and then you had all the lending in 2021 that peaked out in early 2022 once the Fed started to kind of slam on the brakes when it came to liquidity. Now this is part of the story. What you can see is the 1-year chart. It's starting to flatten out, but it's still rising. It's not rolling over. In fact, you did make a new cycle high here at a nearly 4%. So we'll be watching this to see if it does continue to break above that 4%, or do we get a rollover? If we get a rollover, that would be an indicator that things may be in trouble in markets. Okay, but so far right now, everything's kind of holding in there. I also want to highlight this is the Treasury General Account. Okay, U.S. Treasury General Account. I've said this is the checkbook of the government, and when this is rising, it means money's being taken out of the system. Okay, meaning there's a lot of issuance going on. And you can see here, this is, remember the market kind of reflected strongly in the summer of 2020. That's because what happened was now suddenly all that money in the bank account of the Treasury that was being spent out in the economy in a big, big way. It got so big, nearly $1.8 trillion, over $1.8 trillion, and then it was drawn down to nearly zero. That money was spent out into the economy. And so when this is falling, that is positive for liquidity. Okay, now this is kind of going sideways for over a year now, pushing on a year and a half. So it hasn't really done much to the economy in the past 12 months. But if we hit this debt ceiling, which we're pretty close to that, and the Treasury starts to spend down this money, I know Doge is trying to cut all these expenses, et cetera, but we'll see. But eventually, you just to pay Social Security checks and Medicare and Medicaid, all of that, they're going to need to start spending this, and that is actually going to be positive for liquidity. So what I'm saying is actually the debt ceiling is positive for credit markets, and as long as bank credit continues to go up, those are the two main drivers of liquidity in the system. And so that is the backdrop, at least in the short term, that you need to pay attention to and make sure that you're not jumping the gun and getting too bearish or anything like that in the short term. Okay. So let's talk. Let's pivot over here and look at the S&P 500. Okay, I'll do the SPX, it's the cash index, and we'll zoom in here. And what you can see here is there's definitely some weakness here, MACD divergence. This is not a strong high. Okay, it's in an uptrend still, but definitely losing momentum, is not looking great. Now, does that mean this has to be the top? No, it could just be going down to the low end of this range, around 5,800 on the S&P. That's only another 3-4% from here, and then could you get a bounce and a new high? Absolutely, that's possible. Okay, but we are getting a little bit long on the tooth, and I do think this is a year that's going to be more volatile than the last couple of years. So you should expect that, especially as we get into the back half of the year. So for now, I think you still have to err on the side of this is a dip to buy, but you're starting to creep into more dangerous territory. Let's just say that, more dangerous territory. Now I'll be watching this. Here's the move index. This is another indicator that risk is creeping into the market. You have a higher low on the move index, and if this breaks out above the 104 level, that's starting to tell you that there are some problems in Treasury land and with broader liquidity. You can see this with the Nasdaq. That did not make a new high. This is rolling over. This is extreme. This is weak. This is turning from neutral to weak. And look at this breakdown here. And I said this before, this is this blue line. If you do not, as long as you don't break above this blue line, this sell-off on the 18th of December is negative. It is bearish. Okay. And so this is a strong indicator that the market is at best in a choppy environment right now. Okay, so I am starting to move to neutral on the market. Now, once again, it's that backdrop of liquidity that I think in the near term probably holds things together. But at some point when the Fed or the government comes to a resolution on the debt ceiling and start to issue treasuries again, et cetera, that's when you could see a spark of liquidity coming out of the market. And obviously with policy uncertainty, that bank credit could roll over as well. I'll be watching that, and that will be a very important indicator to follow. Let's take a look at the credit markets. This is also another indicator that probably short term everything's going to be okay, but you don't want to get overly bullish right now. So this is in a choppy environment. It says making a lower high here, so that's of note. This is short-term junk to short-term treasuries. As long as this is an uptrend, credit markets are fine. You get a breakdown, you get a lower high, potentially a lower low. Now you're in a downtrend, and that's when credit markets can signal the equity markets could have a much broader pullback. Okay, so we'll certainly be watching that. And then here's growth to value. You're starting to get that rollover in the growth side of the market. Poor, lower high here, and obviously this leads the market to grow. The S&P broadly, it leans on the growth side because you have the Nvidias of the world. Let's just cycle through these, right? Nvidia a lower high here. Microsoft certainly not making a new high. Apple is one of the stronger ones, but still not at that new high. Let's see what else. Let's go to Google. Google had a bit of a breakdown, and that continues to the downside. Meta is definitely the strongest, but had a rougher week. We'll see if we get a rollover there. Netflix was crushing. That's still doing, definitely of the major names, is doing the best. Tesla, this is a strong rollover, right? A big surge higher on the Trump win and Elon being part of that, and Doge. But how much is Doge going to hurt broader credibility with Elon and the broader electorate? I know a lot of people that are Republican, they love Elon, but how much change is the broader electorate wanting to see, and is this the right change for the broader economy? If this spins us into a recession, this could really damage, I think, the Elon brand. So something to consider as Tesla continues with its weakness overall. Let's take a look at gold, GLD. That is still holding in there. You do get a pullback in the miners, but as long as gold's sitting pretty up here, those dips in the miners are definitely ones to be bought overall. Let's take a look at what I want to get to. If there's any other topics that I want to get to. Oh, here's Amazon. I didn't show you Amazon. Amazon certainly rolling over. Small caps, this hasn't made a new high for a while, so definitely some weakness there. Let's take a look at this. I wanted to see this compared to the Qs. Yeah, small caps not gaining traction compared to the Qs. Here is consumer discretionary. That is rolling over as well. So definitely some weakness out here in markets. You're seeing some, let's go to the bonds, right? Bonds are getting a bid. Here's the IEF, the 10-year, the dollar. It did have a bit of a bid, but that has been weakening on the back of the market starting to price in a more dovish Fed over the next few quarters. And then let's look at like utilities. Utilities are gaining some strength, so flight to safety there. XLP, flight to safety there. This is the consumer staples, and then you have healthcare also getting a bit of a bid, not quite as strong, mainly because you're mixing in the biotechs, and that looks very weak. Biotech remaining very weak. So if you're buying healthcare, you want to be very selective there. Uh, we like the medical device companies over the pharma companies mainly. Let's take a look at transportation. Transportation's rolling over as well. So a lot of weakness out there in markets that has turned this market into much more neutral. Okay, now not calling a top, but I am also saying I'm not bullish either. But remember, markets can kind of consolidate. They can chop sideways. They can correct in time as much as they can correct in price. Okay, so a lot of people think, oh, the correction has to be in price. You have to see a 20% drop in equities. Possible, but you could also correct in time where the market kind of chop sideways. And that's what you're seeing here, I think, is a lot of opposing forces. You have policy uncertainty, you have some economic weakness, and then you have the positive liquidity dynamics of the Treasury general account rundown. You have bank credit still rising. You have consumer balance sheets generally strong, et cetera. And so it's definitely a more neutral environment, and you have to treat it as such. So we're being a bit more patient for our newer clients, trimming some gains here and there, not getting overly bearish, but certainly time to rebalance the portfolio, raise a little bit of cash, so that even if you get a choppy environment, you can buy on dips, and you can play kind of the low end of the range. And I think that's probably the more likely scenario for this year. Once again, a more choppy environment, especially in the first half of this year. Now, the back half of the year, I think that could get a bit more bearish, but you don't want to call that too soon. Because this could easily be just a minor pullback, and we can make another new high in the second quarter. I think that is certainly a possibility. You cannot rule that out. You have to call the balls and strikes as you see them, and be fair with your assessment, and not use any political bias or any bias at all to paint a picture of the market that is not really there. And this is my assessment of where the market is right now. It's neutral. It's neutral with probably a slight odds of a more bearish outcome in the next 2 to 3 quarters versus the odds of another new high in equities. That's certainly possible, but I'll give the slight edge to that downside over the next 2 or 3 quarters. All right. Well, I think that about does it. Appreciate you all tuning in, liking, and subscribing to this video and our podcast, InvestTalk. If you ever want to connect with me, head over to investtalk.com, click on the portfolio review button, and we'd be happy to assess your personal situation. I thank you all for tuning in. Hope you have a wonderful weekend. Reminder that the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell a security or to participate in an investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Have a wonderful weekend.